Hi everyone. In this video, you will be learning accounting of debt instrument, and we will be taking an example of bond, that how to account for bond considering various cases. If we are in a business to collect the cash flow, if we are in business to collect the cash flow and sell as and when required, or we are in the business of trading the bonds, we will see the different kinds of accounting that can be done around the bond. So, just a quick recap what we have covered in the last lecture is, if you want to do the accounting for a debt instrument, first you need to analyze your business model. If your business model is to collect just the cash flows of that debt instrument and you will sit on it, whatever happens, you will never sell it. You will just sit on it. And that debt instrument is generating return purely vanilla interest, a simple lending arrangement, nothing derivative, nothing like that. Pure lending arrangement is there. Then you need to record your that asset at amortized cost. How to calculate the amortized cost, we will see just a matter of few minutes. And if your business model is to collect cash flows, but you think you can sell it as and when you need, then it says you cannot show it at cost, because there is risk, because you can sell it. So you need to show the fair picture. So when you need to show the fair picture, then you need to do the accounting at fair value. You need to show the asset at fair value. And the changes in asset are recorded in OCI. Because you're not into the business of trading the bonds. Your objective is to collect the cash flows, but you want to take an advantage. Like, if there is a very good premium you're getting, or if you think you need some money, you want to have some liquidity, then you need to recognize your asset at fair value through OCI. And here also, the instrument in which you are investing is nothing but where the payments are just of principal and interest. You will be getting back your principal and interest, simple lending arrangement. That's the word, simple lending arrangements. And so interest is not to be related to any kind of derivative, any other option is attached to it. If that is the case, then it will not justify the first two condition. It will fall into the third category, that is a residual category. If you are does not fall in any of this category, you have to compulsory recognize your asset at fair value, and the changes in fair value are recorded in PNL. So let's see how to account for bond. We will see a wonderful example, and in that example, I'll try to cover each and every point of bond, and I will go from the basics and to the advanced level. So let's see. So just just write down the points. If you have a pen and paper, just write down the points and take your calculator. It will be a better, it will the understanding would be very better, very good. So let's see. So if you have invested in a debt instrument, that is a bond. So you have invested, so your ABC Inc, ABC Incorporation, and you have, in the starting of 2021, you have purchased a bond, and it has a life of 5 years. It will be maturing on 31st December 2025. You got that bond for 9200. You get that bond for 9200, whereas the face value is 10,000. What is the face value? Face value is that value on which the interest is calculated, on which the coupon is calculated. And so that bond keeps a coupon of 5%. So how much interest you will be getting? 10,000 into 5%, that is 500. Okay. But when you purchase this bond, you need to incur an expense of 250. You can say stamp duty or something like that, taxes or anything. You incurred an expense of 250, brokerages or anything. Okay. So that is the question. So how do we record for bond? So mark my words, every asset at the initial recognition is measured at fair value. Every asset at the initial recognition is measured at fair value. So what is the fair value? The value which we have invested. In 2021, we have invested 9,200 for bond and we have incurred 250 its transaction cost. So we have spent 9450. Okay. You spent 9450 for bond. Okay. So what will be your entry? It's as I told you in the very first episode, the basics of accounting. Whenever asset increase, you will debit the asset, and asset decrease, you will credit the asset. So the bond asset, your purchase amount is increasing, you will debit it, and your asset, cash asset is decreasing, you will credit it. So bond to cash is your entry. Okay, so that is the case. Okay, so let's see what business you are in. So you are in a business to collect the cash flow. You just don't want to, you just make a purchased a bond. After 5 years, you will take back the principal and you want to have that 5% interest. That is your motto. Whatever happens, whatever be the condition, you will sit on it and earn just the coupon. So IFRS 9 says show it at amortized cost. What is the amortized cost? How we calculate it? We'll see in a minute. So if you need to show it at amortized cost. And when do you need to show it an amortized cost? You take transaction cost as a part of your cost. Okay. So we have included this in the cost. So on 1st January 2021, you have passed the entry 9450 debit and 9450 credit, debit bond and credit cash. Okay, let's see how to calculate the amortized cost for each year and what interest income you will earn. Okay, just tell me what is the interest income you earn. How much you have invested? You have invested 9450. Okay, you have invested 9450. You have invested 9450 and you will be getting 500 each month, each year, and you will be getting 10,005 at the end of last year and on the maturity. So just think about it. Have you earned 5% or more than that or less than that? So obviously more than that, you have not invested 10%, 10,000, you have invested 9450 and you're getting something more. So you have, so you need to calculate what return you're earning. So you will calculate IRR. So how we calculate IRR? It's manual. It may be a bit complicated. Not complicated, it's easy, but in Excel it's damn easy. How we calculate? Just see the formula. You just write IRR bracket all the cash flows, you will get the return. So on this bond, so you are earning 6.32%. Okay. So how do you, so what interest income you will be showing? So you'll be showing 6.32% on amortized cost. Your amortized cost is 9450 and this you're earning 6.32%. You will calculate, you will get it 597. So for the first year, you will be showing in the P&L, you have earned 597 and not 500. So you will increase the value of the bond by 597. Okay, so you have bond for 9450 and you have earned 597 of interest. So your value of the bond and minus you got 500 out of it as a coupon. So your value of the bond will be 9547 at the end of 1 year. It is also known as gross carrying amount. For next year, you will earn 6.32%. You will earn 6.32% on the gross carrying amount. This time it will be 9547 and you will find it comes out to be 603 rupees. Okay, and then you also got 500 rupees as a coupon and you will show your gross carrying amount at this price. So this way we do the accounting for amortized cost. You will show income as per IRR method. So what is actual return you need to show. So the purpose is always to show the true and fair picture. So you're earning 6.32%, so you will show 6.32%. However, if you're getting less amount, so it is your kind of data you will be getting in future. I hope it is clear. Okay. So what journal entries will you pass? So whenever you accrue for the interest, you will debit bond because it's increasing your asset, the bond asset, and whenever it increase in income, you credit income. So you will credit your income. So debit bond, credit interest income by 597. Okay. So whatever go by the above chart for each year, you will be passing this entry. Bond account debit, investment in bond account debit to interest income. We will go by this calculation. Okay. So each year you will be showing this. So these are your journal entries. Okay, and whenever you get interest payment, you will do simply debit cash to credit bond. So you have increased your asset by the interest income that you accrued, but you whatever you get, you decrease that. So cash account debit to bonds by the coupon payment and at last coupon plus principal. So just look at the entries. I hope it's clear. If we are good, we can move to next example where but one more thing, if you have another information at the end of year one, you have the value of the bond is 9091. The value of the bond is 9091. Is it any relevant information when you are doing the amortized cost accounting? Even if it reaches to 1 million or 10 million or zero, we are not bothered because we don't want to sell it. We will keep showing it at amortized cost. Okay. So as because that is our business, we will never sell it. But if we are into the business, then if we are into the business, if needed, we may sell it. If needed, we may sell it. So but our main objective is not to sell it. And our main objective is to collect the cash flow. But we are also flexible and we want to sell it as and when required. So it says like, if your main business is not to earn from capital appreciation or something, it says you need to show change in fair value in OCI. Okay, you need to show change in fair value in OCI. So the second example, the business model is collecting cash flows and selling. Let's see how we do the accounting. For this, I tell you do all the same calculation that you do for amortized cost. Okay, you do the same calculation for amortized cost. Okay, the same calculation. You have earned the interest of 6.32% and interest income is this. You will keep showing your P&L by the same amount that you are showing in amortized cost. In P&L, you will take the same amount. In OCI, you will take change, you will be recording only the change in the fair value. So what are the steps? So what all we need to consider in the statement of financial position, that is balance sheet, you will show your asset at fair value, as we just see, like 9091. Okay, we will come to it. In the profit and loss account, you will keep recording your interest revenue on IRR basis, like 6.32%. And in the comprehensive income, you will take changes in fair value. Okay, so this is the additional step. So whenever you have a business model of collecting cash flow and selling it, the accounting will more or less same, but it will be a bit enhanced version, you can say. You have to calculate the actual return you are earning. So your actual return is 6.32%, that is IRR. You will keep showing the interest income basis on that, taking amortized cost, multiplying it the actual return, you will get your interest income. So in the P&L, you will keep doing the same entry, bond account debit to interest income, bond account, and the interest is calculated at IRR, that is effective interest rate. We call it in IFRS 9. And for payment of principal and interest, these entries will remain same. Your cash is coming, so cash account debit to your bond value will be decreased by the coupon amount that you get. I hope it's clear. So, but your objective is sell as and when required. So you need to record it at fair value. So what additional you need to do is, so the market price is 9091 and face value is 10,000 and so fair value is 9091 that we will show in balance sheet. In balance sheet, you were showing as per amortized cost, your value is 9547 at the end of year one. Okay, 9547. It was your balance sheet value. So change in the value. So is 456. So there is a change in your fair value. The value is 456. So you will credit the bond by 456 in balance sheet. You have a set as 9547. You will reduce it by 456 rupees and debit. So this loss will be recorded in other comprehensive. You will not take it to P&L because that is not your main objective of the business, but you have to show your asset at fair value. So you will take this loss to other comprehensive income and credit asset, that is other comprehensive credit bond. The last case, when your bond does not meet the business model test, that is, when your objective is not to hold the cash flow, not to hold the cash flow, you want to earn out of capital appreciation or you want to trade in that, you don't wish to hold it. Okay, so the very first criteria does not meet. So it has to be valued at fair value, and the change in the fair value will be recorded in through profit and loss account. Okay, so what entry will pass here? The finance expense, the transaction cost is treated as your regular business expenditure and is not part of your asset. Okay, so the expense, whatever you incur, the transaction cost, it will directly go to P&L. So enter will be transaction cost to cash, and the asset you purchased is bonds, that is bond to cash. So entry will be bond account debit, finance expense account debit to cash. So asset is increasing, expense is increasing, both should be debited, and asset is going, so it should be credited. So it's clear. And on subsequent measurement, you have to record at fair value. So in balance sheet, it was at a value of 9200 at which you have purchased it. Its value reduced to 9091. So you will book your loss in P&L. In P&L, you will show or you have a loss of 109 and the value of asset will be decreased by 109. So entry will be fair value loss account debit, fair value of bond loss account debit to the bond. So debit P&L for fair value loss and credit the asset because its value got decreased. And there is nothing like IRR. You will just record whatever the coupon you will receive, that is cash account debit to P&L, that is finance income. I hope it's clear.